Hello learners, welcome to our session today. In our class today, we are going to handle a very important concept in our syllabus. So, I wish you to sit down, relax, and follow the class. In the event that you have any question, you can always engage us. For those probably who are viewing this video through our app, what you can do, just go to ask button question below this video. Ask that question in the area that you feel you are going to go to the concept correct, and we'll assist you. For those who are viewing us through Facebook right now, on the comment button, you are free to ask any question. And for those who are viewing us via YouTube, still you can ask your question on the comment button. So, in our class today, my good students, I'll handle a very important concept that at least all of us must always be having. We must always have at the back of our mind. Not only for the purpose of examinations, but also for the purpose of applying it in a practical world. Because this unit of taxation is not all about passing exams, but it is very practical. So, in handling this concept of incorporated entities, ideally you are talking of limited companies, it is very key in any registered company. And at times you'll also find that there are some mistakes probably that accountants normally make due to ignorance or lack of knowledge. So, I want us to pay very keen attention on this concept. First of all, we need to understand what a company is. Of course, we know very well that a company has a separate legal entity whose existence is distinct from that of the owners. It's not like a partnership, whereby partnership, remember we noted that at this point, whenever I'll be dealing with partnership, I'll be taxing individuals, but not the company as a business, but not the partnership as a business. But for companies, I'll have to tax the company itself, because on registration is going to be given its own existence and its own name. So, in simple terms, elements that you must always be having at the back of our mind whenever I'm dealing with limited companies is, first of all, to understand that company, of course, has a separate legal entity. We are saying that a limited company has a separate legal entity, whose existence is distinct from that of the owners. From that of the owners. Very important concept that you must always be having at the back of our mind from now on. The moment you've started this concept, we should always be having this in mind, that a limited company has a separate legal entity who's distinct, whose is distinct from that of the owners, whose is distinct from that of the owners. Now, because you are talking of the income that this company is going to generate, is all that you're going to tax, we normally also say that probably I could be having a company dealing with electronics, and I'm having rental houses somewhere. So in that event, you'll find that I'll be generating what? Rental income from my other sources of income. So when I'm handling the concept of, or rather when you'll be handling the concept of a company, you'll find that I'll also have to aggregate the other incomes that you've earned elsewhere, so long as they relate to what? They relate to the company. Probably or rather in that case, they could not be probably the direct income the company is generating from its main activity, but probably we've invested somewhere else. So we are saying that in this case, that where a company derives income from other sources, where a company derives income, where a company derives income from other sources, besides principal's activity, besides the principal activity or income, we are saying that such incomes belong to the company, 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 and will be taxed as an aggregate, and will be taxed as an aggregate, will be taxed as an aggregate. Whenever we are talking of being taxed as aggregate, ideally it means that I'm going to take the income from our main activity, we add the other incomes that we've generated from other activities, summing them together and tax them as one income, So after we've understood this concept, another key concept again that you must always be having at the back of your mind, because at this point you say, maybe I'm selling electronics, being our main activity, assuming I'm having, say, like 2 million being our income. I could be having such other incomes elsewhere, talk of rental income, for example, maybe 1 million. So the 2 million is from our main activity, correct? Rental income is from our other sources. So we are saying if I want to determine the income to tax on this company, I'm going to take the one from our main activity, we sum it up, we aggregate it with other sources. Then we tax them as one income. That should bring us to what are the rates of tax whenever I'm dealing with what? Whenever I'm dealing with companies. So whenever we are dealing with companies, we normally say that the resident body corporates are taxed. Talk of resident, and mark that very key. Resident body corporates. Resident body corporates are taxed at the corporation rate, are taxed at the corporation rate, of 30%. And keyword is resident. Keyword is resident body corporates, because recall we'll also be having what? Non-resident. And I believe in our previous session we had looked at the qualification of a company to be a resident company, and we mentioned roughly like 3 main points that you must always be having at the back of your mind. So you are saying that the resident body corporates are taxed at the corporation rate of 30%. The question would be, what about non-resident companies? So, looking at non-resident companies, talk of non-resident body corporates. In this case, you are talking of the rate to be 37.5%. We are talking of the rate to be 37.5%. This is for non-resident body corporates. This is for non-resident body corporates. They are being taxed at the rate of 37.5%. Now, There's also another key concept that we must always be having at the back of our mind, which in this case, remember, we could be having like new listed companies. On these new listed companies, we normally have different categories of taxation. It's not like for a newly listed company, we are not going to tax it if, irrespective of, say if it's a resident company, I'm not going to tax it at a corporation rate of 30%. If it's a newly listed company, we normally have different categories depending with the listed shares, depending with the percentage of listed shares. Of course, that one, we had talked of that in our previous classes. And remember, this is what is being applied. But of course, with this pandemic, with Corona, we now term them as what? Corona rates. Corona rates, remember, for corporation tax rate is 25%. But that one is practical. For the purpose of your examinations, you are going to be tested with the one for 2019. So, for the purpose of your examinations, you'll be using 30%. While you will be preparing your books, probably if your financial year is ending within this year after the rate was amended, you are going to use 25%. It's just like VAT. You see, like VAT, the Corona rate for VAT is at what percentage? It is at 14%. So we must always be very updated when it comes to the aspect of taxation. So in this case, you are saying that for the purpose of exams, we'll be using 30%, that is for resident companies. For newly listed companies, I'm not going to handle it in this class because you had already talked of taxation for newly listed companies. Taxation for newly listed companies. Now, another key concept that you must always be having at the back of our mind whenever I'm dealing with the aspect of taxation in regard to limited companies, we normally say that all body corporates incorporated in Kenya, all body corporates incorporated in Kenya are expected to pay installment tax before the end of the accounting year. We are saying that all body corporates incorporated in Kenya, they are supposed to pay installment tax before the end of the year. That one we can put it down. Remember, we are marking the notes for brief revision, and we have our revisions which are ongoing. Both live classes, which in that case we normally conduct them as per the set timetable that is online, and you can as well download our phone application if you've not downloaded it from Play Store. The phone app is M-Darasa. Go to Play Store, search M-Darasa, the best e-learning platform in East Africa. Download the phone application, create your account, and engage us in areas that you feel you want more assistance by, of course, studying our video tutorials. So, we are seeing that all body corporates incorporated in Kenya, they are expected to pay what? Installment tax. So that should take us to the concept of what? The aspect of installment tax. In fact, you can put it down. We are saying that all body corporates incorporated in Kenya, all body corporates incorporated in Kenya, all body corporates incorporated in Kenya are expected to pay installment tax. Are expected to pay installment tax, are expected to pay installment tax, are expected to pay installment tax before the end of the accounting year. Before the end of the accounting year. Before the end of the accounting year. This is very key, my good students. This is very key for you to grasp this concept clearly. We are saying that all body corporates incorporated in Kenya are expected to pay installment tax. Installment tax before the end of the accounting year. Before the end of the accounting year. Now the question would be, how will we determine this installment tax that you're supposed to do or that you're supposed to pay? How are we going to determine this installment tax that you're saying we are expected to pay, being an cooperated company in Kenya? So we normally say that installment tax, of course, how are we going to determine that? So we are saying that amount of tax payable shall be determined, amount of tax payable, amount of tax payable, amount of tax payable shall be determined, shall be determined, shall be determined, shall be determined at the beginning of each year, at the beginning of each year, at the beginning of each year. Maybe to understand the concept of installment tax, you'll find that for us to estimate this installment tax, for us to estimate the installment tax, we normally have it in this case because we are going to pay this an aspect that I'm estimating at the beginning of the accounting year. After we've estimated the component of tax that I am expected to pay during that year, we are going to divide that tax, of course, by 4 installments, so that in the event that I'll be paying them on an installment basis. But remember, we are saying that this tax that you are saying you are going to estimate as at the beginning of the year. Say, for example, we have estimated that the amount of tax I'm supposed to pay at the end of the year, say it is 2 million, assuming this is 2020. We have estimated that the tax that you are supposed to pay is 2 million. This 2 million, I'm not going to pay that at once. I'm going to divide this 2 million by 4. I'm going to divide the 2 million by 4. So that I should be having, say, like 500,000. So the 500,000, I'm going to pay it on 4 equal installments. That is 500,000, 500,000, 500,000, and talk of 500,000. So by the virtue of us paying it in bit, that is what you are saying is installment tax. But remember, we've estimated it in January. We have estimated it as at the first month, that is as at the beginning of the accounting year. So of course we'll be looking at the dates of how we'll be paying this installment. First of all, I needed you to get the concept of installment tax on that we are seeing. Now another question would be, how will we estimate this amount that you are supposed to pay? We are saying that amount of tax payable shall be determined at the beginning of each year. The question will be, my good students, the question will be, how are we going to determine this tax that you're supposed to pay? So you normally have 2 ways of determining the tax that you are expected to pay. You normally have 2 ways in determining the tax that you're supposed to pay, and these are the ways. We normally talk of 2 ways in determining the amount of tax that you're supposed to pay. So we can say that this is based on the higher of the installment tax that, or rather tax that you're supposed to pay. We are saying that this is based on the higher of, this is based on the higher of. Mark it very clearly. The higher of what? The higher of 110% of the last year's tax liability. This is based on the higher of 110% of the last year tax liability, of the last year's tax liability, and of course the budgeted profits for the year. The budgeted profit for the year. The budgeted profit for the year. My good students, I want you to understand this concept clearly. We are saying that for us to determine the amount that you are going to pay on installment, we'll be taking 100% of the last year's tax liability or the budgeted profit for the year. Now, the budgeted profit for the year will fit in very well if I'm dealing with a new company, or if I'm dealing with a company that probably made a loss in the previous accounting year. Most of the cases will always estimate it on 110% of the tax of the last year's tax liability. And whenever you are talking of estimating it at 100% of the last year's tax liability, this is a concept that I want you to grasp very clearly. This is a concept that I want you to understand very clearly. Remember, we've said this is not only for the purpose of us doing examinations, but also to assist us to understand this concept when it comes to practical manner. So we are saying that 110%, assuming that in 2019, our taxable income, our taxable income was how much? 10 million. That was our taxable income in 2019, assuming our taxable income in 2019 was a figure of 10 million. How am I going to estimate the tax as at the very beginning of this year? We are going to do this. We are going to take the tax payable for last year would have been how much? Would have been 30% of 10 million to give us how much? To give us 3 million, right? Then it is this 3 million. Now I want to do my estimation for tax that I'm going to pay in 2020. The tax that I'm going to pay in 2020, we are saying I'm going to take the 3 million, we multiply by 110%. We assume, the taxman assume that you are going to increase your profit by 10%. So in that case, I'm going to estimate it by aspect of 110%. That should give us a figure of how much? That should give us a figure of 3.3 million. So this is how I can tend to estimate using the first case that we've said, 110% of the last year's tax liability. So the moment I do have the estimated amount that I'm required to pay in 2020, it is this amount that you are going to pay on installment. And we normally talk of what? 4 equal installments. We normally talk of 4 equal installments, of course, for any company that is not in agricultural sector. We'll also see how we normally pay installment on the farms that are allocated, or rather the farms that are in agricultural sector. So this is how we can estimate. So this is the amount that we're going to divide by 4, then we pay it on an installment basis. Talk of the budgeted profit. Of course, it is an assumption that every company must have a budget. It's only in Kenya where you can go to a company and request for a budget and you will not be given, which is very bad, Of course, if you want to measure our performance, budget is always very key. Budget is always very key. Of course, the budgeted profit, ideally, you are saying that I'm going to estimate, of course, in our budget as at the end of this year, what will be our profit. And is that profit I'm going to tax at the rate of 30%, and of course, we pay it on installment. So, after we've looked at this concept, I want us now to talk of the dates of paying the installment taxes. Once we have determined the tax to pay, how are we going to pay for that on installment basis? So we are saying that in this case, once determined, the installment tax is payable as follows. So we are saying that once determined, I can have it here. We're saying that once determined, the installment tax is payable as follows. Once determined, the installment tax is payable as follows. Once determined, the installment tax is payable as follows. Once determined, the installment tax is payable as follows. Because remember, we said that we're paying it on 4 equal installments. So this is how we are going to pay it. So we normally talk of first installment. In this case, we normally talk of 25% of the tax due. 25% of the tax due. 25% of the tax due before 20th of the 4th month. Before 20th of April, 25% of the tax due before 20th of the 4th month, which in this case we are talking of what? Of April. Then what about our second installment? Our second installment, we are going to pay 25% of the tax due. We are going to take 25% of the tax due, 25% of the tax due before 20th of June. Before 20th of June. What about our third installment? Our third installment, my good students, our third installment, the same story will apply. Our third installment, I'm going to take 25% of the tax due, 25% of the tax due before 20th of September. And what about our fourth installment? Allow me to erase here. What about our fourth installment? So our fourth installment, we are going to pay 25% of the tax due. We are going to take 25% of the tax due before 20th December. So we are looking at 4 equal installments, whereby in this case you are saying that if I want to pay for my installment, I'll consider it on this basis, whereby we are going to talk of the first installment, 25% of the tax due before 20th April, second installment, 25% of the tax due before 20th June, 25% before 20th September, and the last installment, 25% before 20th December. How are we going to work it out? Like in the illustration that we had, we said that assuming that in this event probably I'm having 3.3 million, the amount that we've estimated that we're going to pay, we are going to divide by 4. Then after dividing our amount by 4, that should give us a figure of how much? That should give us a figure of 825,000. So I'm going to pay the 825,000 on 4 equal installments. That is the first installment before 20th April, second before 20th June, third before 20th September, and fourth before 20th December. So this is what you are going to pay. A good student will ask Mwalimu, what if as at the end of the year, I've realized that the amount that I had estimated probably is lower or higher than what we are actually receiving? How are we going to work it out? So that should take us to the final tax balance. How will you compute your final tax or tax balance? So my final tax balance, talk of our final tax. After we've done all these installments, how will we arrive at our final tax? or our tax balance. How will we arrive at our tax balance? Therefore, our tax balance, we are going to achieve it this way. We are going to take our actual tax payable. This is final tax. We are going to take our actual tax payable, we less the installment tax paid. We less the installment tax paid. We less the installment tax paid. This will give us what? Our final tax. This will give us the final tax that I'm supposed to pay. That will give us the final tax that I'm supposed to pay. So like in this case, for example, maybe I had estimated that I was supposed to pay 3.3, and that is the installment that I paid through these 4 equal installments. And probably our actual, this was estimated, right? This was estimated. And probably our actual tax that I'm going to pay maybe is 3 million. What will happen? You are saying that I'm going to take our actual, we deduct our estimated. So in this case, it's as if I'll be having a refund of how much? 300,000. I'll be having a credit of 300,000, which you can request for a refund. What if in the event that I'm having actual amount, probably I'm having 4 million? What if in the event that in this case I'm having the actual of 4 million? What will be our tax balance? Our tax balance, my good students, I'm going to take our actual, we deduct our estimated to give us a figure of how much? 700,000. This is the amount that I'm going to do, or that's the amount that you are going to pay. That's the amount that you are going to pay. So this is how we can work out the installment tax. That is how we can work out our installment tax. That is how we can work out our installment tax. But there is a very important concept that I want you to grasp very correctly. Probably you've never heard of it. Probably you've never heard of it, or maybe it also depends on where you are studying. Probably you've never heard of it. What if I'm having a farm that is in agricultural sector? What should be our installment tax that we will be paying? Suppose I'm having a farm in agricultural sector. These are farms in agricultural sector. Talk of farms in agricultural sector. Farms in agricultural sector. Farms in agricultural sector. How are we going to pay for the installment in farms in agricultural sector? For farms in agricultural sector, my good students, this is how we are going to handle it. This is how we are going to handle it. I'll be having only 2 installments. I'll be having only 2 installments. That is, our first installment, we are going to pay 75% of the tax due. Estimation is just the same. Estimation is just the same. But on payment, I'll be having 75% of the tax due. This is before 20th of the 9th month, before 20th of September. Then the second installment, for second installment, I'm going to have it at the rate of 25%. I'm going to have it at the rate of 25% of the tax due, before 20th of the 12th month. That is before 20th of December. Before 20th of December. Before 20th of December. That is for farms that are in agricultural sector. These are for the farms that are in agricultural sector. So the moment I'm able to do this, how will you determine our final tax balance or the aspect of tax balance? To determine our final tax, the same concept will apply. I'm going to take the actual tax payable, we less the installment tax that we have paid. We less the installment tax that we have paid. We less the installment tax that we have paid. So this is a very important concept for any student doing tax, for any accountant practicing accounts. This is very important concept. Remember, we should approach this taxation paper not only for just passing exams, but also we should be having that zeal, we should be having probably that interest of getting the knowledge to apply it outside here. So after we've talked of this first concept of company, the next concept that I wish you to join me in the next session, we will be looking at allowable expenses for companies. We'll be looking at some of the non-allowable expenses for companies. We'll go ahead and look at the format of preparing the taxable income for companies. Then we proceed to handle an illustration question. So join me in the next session, my good students, where we will be looking at allowable expenses, non-allowable. We look at the format and we handle the question. We will have to approach it with an open mind, just as I mentioned it earlier on. So thank you so much and join me in the next session. Thank you.